Whitestone REIT is a public company. We're traded under ticker symbol WSR. We are focused on neighborhood centers. We're in the largest markets in Texas and Arizona, which would be Houston, Dallas, Fort Worth, San Antonio, Austin, and then in the south, sort of in the south and the southeast and northeast of what would consider the East Valley of Phoenix. So that's Scottsdale, Mesa, Gilbert, Chandler. And a little bit in Phoenix as well, greater Phoenix as well. With this, we focus on centers that are in the best locations in those neighborhoods. So what we look for is demand drivers like job growth, university systems, and places where there's upward mobility. And we look for the best corners in those neighborhoods. So we're looking for high household incomes, and we're also looking for strong vehicles per day. So that's your traffic. And then we look for stickiness of traffic in those neighborhoods as well. With retail has been right-sized. It's taken quite a bit of time to do this, particularly since the financial crisis in 2008. There was so much discussion about retail being dead. And it really what happened is over time, there was less investment in retail, and there was a right-sizing of the space. So what I like to say is that there's been more of a focus on neighborhood centers and less on what used to be large spaces, large boxes, malls, so on and so forth, and much more neighborhood retail. One of the benefits that we have is that not enough of it has been built. And there's a demand with it now that you have convergence of bricks and clicks and also movements more into neighborhoods for this type of retail. So the supply demand has been going in our direction. And of course, retail is not dead, neighborhood retail. So we've been very happy in the space.
Obviously, let's flip the coin. What about the bear thesis? What keeps you up at night? What headwinds do you see, and how do you push back?
I think there's always the challenge. We're a little bit of a smaller company, so there's always a question about growth. And one of the things that I see as a company of our size, we're able to move the needle very, very quickly and pivot, which we did, especially when we started building the company in 2010. We invested in these small centers because we saw a lot of risk in big. So with the risk in big meant bigger size spaces. We went towards centers that had a lot more flexibility in the size space and the type of center. So we had that advantage of being quick to grow, but also a dispersion of risk in our product because of the smaller size spaces. In addition to that, when you have a smaller size space, people have a tendency to think that, that's a mom and pop type of enterprise that is leasing in your center. And that's not, I think there's always the challenge. We're a little bit of a smaller company, so there's always a question about growth. And one of the things that I see as a company of our size, we're able to move the needle very, very quickly and pivot, which we did, especially when we started building the company in 2010. We invested in these small centers because we saw a lot of risk in big. So with the risk in big meant bigger size spaces. We went towards centers that had a lot more flexibility in the size space and the type of center. So we had that advantage of being quick to grow, but also a dispersion of risk in our product because of the smaller size spaces. In addition to that, when you have a smaller size space, people have a tendency to think that, that's a mom and pop type of enterprise that is leasing in your center. And that's not the case at all. What I'm very bullish on is the American entrepreneur, being an entrepreneur myself, is that, entrepreneurs have become much more sophisticated in their startups and the ability and the tools that they have to invest in their businesses. Just-in-time management, point of sale, all these things have really improved over the last 10 years. So you have a better opportunity, and I can't even think of any better time than what I've seen as business formation today with entrepreneurs, especially those that are, in our spaces. We're seeing them grow very, very rapidly. And part of that reason too is because their own organic growth has been so strong. A lot of these people haven't been able to tap into bank credit, after 2008. And so they learned how to grow organically. So we're seeing that strength as well. So I think there's been a mindset of change, especially since COVID. These are the businesses in our portfolio that perform the best, paid the rent, and are growing. I think what's important to think about, again, is that there's a lot of opportunities in the REIT space, but the business has also gotten a lot more concentrated. We're very, very different than other REITs that are out there. Number one, we were the first in this small focus shop space, right, in the centers themselves. So that's all of a sudden coming in vogue, and people have to realize that, you have to operate a little differently in that space. And when you do, part of that operation means being a little closer to the customer and understanding who the neighborhood you're serving. So we're very data centric in doing so. We have used Esri, which is a really great platform to understand your neighborhood, not just the demographic, but understand the aspiration, the needs of that neighborhood. In addition, now you have Placer as well. And Placer is all about using your phone to figure out, where you are and who you are and what your interests are. And again, your aspirations and your needs. Connecting those, we've been pretty early into that space in the very beginning. And in connecting those, we have used that to really build our centers with a quality of revenue platform that has been very successful, and our returns have shown it over the last couple of years in particular. We've been a leader in the space. That being said as well, because we do have smaller centers, we do have smaller spaces, we have risk dispersion in the portfolio, so we don't have a concentration with one type of tenant, and that has really proven really well again during COVID. It has done as well, and also for growth and opportunities going forward, because that smaller type space, you have a wider range of users that can use the smaller space. It's a lot more flexible. The bigger spaces, the bigger type of tenant that you have to have, the less users you have, and the more expensive it is to position that space. So our capital requirements are a lot lower than most REITs as well for investment into our centers.